18.
Welcome to this special State of the Economy discussion. We have two important macro data coming in. The CPI number for the month of August has come in a bit worse than what the street was expecting. The CPI inflation has come in at 7%. The CNBC TV18 poll expected it to come at 6.84. There were quite a few people at 6.9, not too many at 7. It doesn't look like a great deal, probably 15 basis points higher than our poll, but nevertheless, it's a bit of a disappointment that CPI has come in higher than estimated. I will quickly go through the IIP number, which is also a disappointment, but only the top line number. The IIP growth is for the month earlier, July, has come in at 2.4. The CNBC TV18 poll was 4.8. So that also could count as a bit of a disappointment. But I think the bigger disappointment will be on inflation because it's slightly higher than what the street was expecting. I think the food price inflation is what people will watch out for. That's come in at 7.6, 7.62 to be precise, compared to 6.69 in July. And that's a bit worrisome because the government was seized of the problem and they have already banned the export of broken rice. Broken rice also, impacts animal feed. And there was a fear that the patchy monsoon may impact rice production, and that has sent rice prices shooting up. So the CFPI, or the Food Consumer Price Index, has come in at 7.6%. I'll just quickly run you through the other numbers and let us see if cereals is indeed the worry it was. Oh yes, month on month cereals inflation has gone up by about 2%, 1.8 to be precise. But the year-on-year rise in cereals inflation is working out to 9.57. And, cereals is a huge weight in the index. It's, after all, the most important element. And a 9.57% rise or a 10% rise in cereals inflation can be a bit worrisome for the government because it touches everything. I'll just quickly go through and see if services inflation is looking bad. Well, miscellaneous has come in at 5.95, almost 6%. So my sense is core inflation will also come around 6%, perhaps a tad higher than what it was last month. So just to quickly go through the other elements, meat and fish, very benign, just 0.98 higher or 1%. Egg is actually down 5%. Remember, many of these elements were high year ago, and therefore the substantial fall is welcome. Milk and milk products up 6.4%. They're also affected when cereals prices go up. Oils and fats has come down substantially. This was the one that conflagrated to double digits immediately after the Ukraine war, but now things are much better. The inflation is only 4.6. Fruit 7.39. Vegetables 13.23. Again, a point of bother. Pulses 2.5. That's still benign. Cereals inflation has not come off into pulses, has not become a generalized food inflation. Sugar at 4.5. That's the food items. Clothing and footwear have come in 9.9% higher. Actually, we already know footwear coming in nearly 12%, 11.85, and clothing 9.6% higher. So both those continue. They're all elements into the core inflation and are a bit higher than what the market would have liked. Coming to services or miscellaneous, household services comes in 7.5% higher year on year. Health comes in at 5.4% higher. Transport and communication 5.2%. Recreation and amusement 6.9%. Education 5.5%. And personal care and effects 7%. Giving a miscellaneous or services growth, inflation growth of 5.95. But I think the eyesore is the overall 7% number. The Reserve Bank's average for July, August, September is 7.1%. The fact that last month's inflation, July inflation was 6.7, this is 7. The average is still coming to about 6.9 or a little less than that. So clearly we will not go higher than the Reserve Bank number, or so it seems. That is a minor consolation, but nevertheless we could have done without this surprise on negative surprise on this CPI number. Let me invite my guests, Upasana Bhardwaj of Kotak Bank, Nikhil Gupta of Motilal Oswal, Jayesh Mehta of Bank of America, and Abhishek Upadhyay of ICICI Securities PD are all with us. In a minute, we should get even Rupa, Rege, Nitsure of L&T Finance. Upasana, your thoughts first. Would you take this very badly? I guess about 10-15 basis points higher than the street.
Lata, we were at 7.27 with much higher food inflation. So clearly, for us, it's a few bases down.
Okay.
But nonetheless, I think the point is that 7% is a high inflation number, and overall core also is clearly going to be above 6%. Okay. So core inflation and high food inflation, and even if you look at the high frequency data, that too is suggesting that September too has seen persistence in sequential pickup in food prices. Okay. So even the subsequent reading will probably be elevated. And but having said that, I think RBI's numbers are broadly in sync with the quarterly average that we will eventually end up with, and hence not materially would change from a forward guidance of a 6.5 to 6.7% inflation.
Fair enough. I take your point on that. Also, you would say their 7.1% for July, August, September also doesn't merit a change, you think? What is your expectation in September?
Yeah, so we are at 7.2% for September. So I think we'll broadly be at 7.7 or 7.1% for the quarter.
Okay, so they don't really have to revise their number higher. At the moment, the average for July and August together stand at 6.85. So even if they go above 7, they will not. The average for the quarter doesn't look like it will grow above 7.1 at all. To that extent, the Reserve Bank is not going to have any negative shocks. Rupa, any comments on the number? Okay, we'll just get to Rupa in a minute. Still trying to get through to her. Abhishek Upadhyay, your thoughts?
So we were at 6.9, so slightly higher. What we see is food inflation is higher. Fuel and light component is lower. I'm getting core inflation at 5.90, slightly down compared to 6% last month. So internals are broadly, in the big picture, not surprising. I mean, food inflation is the key area of focus. And within food, you are seeing cereals inflation pick up. You could have sensed that from recent announcements by government also in the form of exports
that they were
for
aware
rice,
of
etc.
This.
So clearly that risk is playing out. And we have seen in the past that once cereals inflation goes up, that is a risk to other parts of food inflation as well. So in this
but Abhishek, were you prepared for a 10% cereal inflation? It's coming at 9.97. Were you really prepared for that bad a number?
It is higher, Lata. It is higher, Lata, but we thought the risk is towards a higher number only.
Okay.
I mean, the issue is broadly core inflation not budging down, and you have food inflation, which is not benefited as much as some would have hoped from lower global food prices. And you have this domestic supply situation which is not looking good. So food inflation, upside risk, core inflation not coming down. So RBI should continue to remain vigilant about risk to inflation.
Okay, coming to that in a minute. The industrial growth number, like I told you, has come in at a slightly meek 2.4%. Our forecasts were higher. Nikhil, your thoughts on both the CPI as well as the IIP?
Thank you, Lata, for having me on the show. So, Lata, CPI is not a surprise. We were at 7%. And we expect it to be close to 7% next month, that is September as well, which means the average for the current quarter will be 6.9%, slightly lower than RBI's. But the first quarter, that is Jan to March, is where we believe there could be upward revision vis-a-vis RBI forecasts. Okay. As far as IIP is concerned, we were at 3.8%, and I think you told us it's 2.5%.
Yes.
Yes, which is a concern. But again, IIP numbers are extremely volatile, and we should not take too much from the monthly numbers. But generally, the growth trend as far as industrial and investments are concerned is not where the market was generally expecting, let's say 9 months ago.
Fair enough.
Which is where I believe the growth concerns will come up.
Well, I agree with you that the IIP number, its components and its calculations have been called to question. But that's all we have by way of an advanced indication of growth, and that's not looking terribly good. The power number, electricity number, is what is particularly intriguing at 2.3%. Upasana, does that come as a bit of a surprise? I mean, we were doing fine on power. The fact that electricity year on year is only 2.3%, is that a point of bother?
Lata, we already knew these numbers from the core data that we got towards the end last month. So that is really not a surprise. The 2.2, 2.3% was expected for electricity. It is the other aspects. I think the manufacturing is where I'll be more focused on. And particularly on the consumer side, I still need to see the details though. But I think the consumer segment is where the bigger hit probably would have been. And we'll have to look at the details to know which are the exact components. But I would agree with Nikhil. These indicators are very volatile, and they may not necessarily always reflect the persistent trend going ahead as well.
No, I take your point. The manufacturing incidentally has come in up 3.2%, and consumer durables is minus 2%. So I think that is the one that has dragged. So your worries are, in the right place. Consumer non-durables has come in at minus 2%. Consumer durables has come in at 2.4%. So it's not as bad. In any case, consumer goods has been a bit of a weak link. Consumer non-durables coming in negative, and consumer durables coming in marginally positive. Those are the numbers. Abhishek, any point to comment on IIP, or can we go back to CPI?
Well, so we had expected a stronger number. We thought the previous month the sequential momentum was quite strong, and we finally thought IIP will begin to reflect the strength in some of the other high-frequency data. But this print again has surprised on the downside. And while you mentioned consumer durables is not bad in headline terms, in sequential month-on-month seasonally adjusted basis, it is still contracted. So not a very sound number. At the same time, I would think when you're talking about translation from IIP to GDP, what will be more important is how global commodity prices have come down and the implication of that on the corporate margins, which will show up there. So it was a drag in Q1 because commodity prices were high, input prices were high. It should act on reverse in the second and third quarters.
Yes,
if the drop sustains in international prices.
Yeah, if the stock market reaction is anything to go by, earnings is the last thing we should be worried about. There are people who are expecting, earnings upgrades have come for banks, but perhaps they will come for others. And I think it's come in even for consumer capital goods from Morgan Stanley. So there are a few earnings upgrades that people are talking about. Rupa, Rege, Nitsure has joined us. Rupa, what's your take on a 7% inflation higher than our poll?
Well, I'm happy because my forecast was 7.1%. Yeah, but that was expected because, sequentially we had seen across the board increase in the prices of cereals, pulses, edible oils, etc. And this lingering impact of, the kerosene, LPG prices, which were raised in July, that has also carried forward. And Lata, if you have observed, at the higher end of the curve, even the home prices, rentals are going up. So that must have taken core inflation. So I was expecting 18 to 20 bips increase sequential in core inflation. So my forecast was 7.1%. So it's closer to that.
Core inflation is 10 bips higher. Actually, we are making much of small differences, I guess. Inflation has a ballpark come in line with expectations at a slightly higher end. What makes the combination a little unhappy is that inflation is slightly higher than expected and growth is slightly lower than expected. That's not a very happy combo for an economist or for the stock market. But nevertheless, so the numbers are at the margin a bit disappointing. Jayesh Mehta is with us waiting patiently. Jayesh, does the bond market even care? There is a rally out there.
Yeah, I think from a bond market, we are waiting for some other news, some meetings going to happen, and that's going to be the decider. So
Yes.
we don't know the outcome. It's a digital outcome either way. So if it happens, we could have a further rally, or maybe it can retrace back.
You're
by
talking
20
about the
basis points.
FOMC or MPC? What are you talking about?
No, the index inclusion thing, right? So that's the thing.
Fair enough. Okay.
Right now, that's the big thing for the bond market. But if you look at the OIS market, that's pricing in, right? So, and I would say as of right now, OIS market is pricing in rate hike in September as well as the next policy. So OIS market is pricing in that. So that's priced in. Bond market is waiting for some structural change. If it happens, we'll come to know as and when we'll come to know.
Okay. But the expectation is largely priced in, would you say, the bond inclusion? If at all it gets announced in October, and it will be with effect from probably 6 to 9 months to enable people to register with SEBI or make other arrangements. If the bond inclusion news does come in October, is that priced in, Jayesh?
No, it's not priced in, because it's, as I said, like it may come because we had so many times it coming, not coming, right? There would be some leg of rally further if it gets priced in, even if it takes 6 months for actual money to come in.
Okay. All right. So we could expect a rally if JPM actually makes that announcement in October.
Absolutely.
All right.
Absolutely.
What are you expecting? Sub 7?
Yeah, definitely. So it's like 20 basis point is kind of from here. So it's sub 7, right? So.
Okay. Would you be as bullish, Abhishek, if the index announcement comes, we could see a sub 7 number? I mean, assuming crude is where it is today and assuming 10-year is at 7.18, can we go sub 7?
Well, so Indian bond yields have been quite resilient to the rise in global yields because of this index inclusion potential announcement. Also, lower crude prices have helped. I think before the February budget, when these rumors were there about index inclusion, I think 10-year bond yields were around 670 mark. Since then, the world has changed a lot in terms of how central banks have reacted, global commodity prices, etc. So yeah, I do see scope for yields to come down. How much? I mean, below 7% if it sustains. I mean, we have to see. But yeah, I mean, some more downside towards 7% levels if the announcement is positive.
Okay, fair enough. But before that, let's come to the Reserve Bank's reaction to the CPI numbers itself. Let me start with you, Upasana. How will the Reserve Bank look at these numbers, and what are you penciling in on September 30th?
So, Lata, like I said, I don't think much changes to their averages. So that is one thing. And apart from that, of course, our expectation is for a 35 basis of a rate hike. That will bring the repo rate at 575. So for this meeting, that's where we are. And for the subsequent meeting, we're expecting another 25 basis.
Okay. So your terminal rate as of now is 6%. Peak rate for repo.
For this year, yes. We will have to look at how things evolve over a period of time. But yes, for this year, we are at 6%.
Yes. We could all be speaking too soon. There is the US CPI number in perhaps 48 hours. And there is the FOMC meeting. So we, of course, have to be, like they say, data dependent. What are you expecting, Nikhil, on September 30th and in terms of subsequent rate hikes?
So, Lata, we are also seeing 25 to 35 bips rate hike on September 30th.
Okay.
And another 25 possible in December, which means we are seeing terminal rate not only for this year, but generally in this cycle at 6%.
Oh, all right. Let's hope that's where it stands. We are looking forward to, of course, more positive news from the geopolitical front. Rupa, your thoughts?
If RBI's projections, if it undershoots, the actual inflation trajectory, then only they will be less aggressive. But personally, I feel that they were quite right, because they have expected inflation. Average inflation was for this quarter at 7.1%.
Yes.
So this is closer to their projections.
Yes.
And they have been giving this message very clearly that they will front load the rate increases. So everything will be governed by what Federal Reserve does. But I personally, Fed raises by 75, then we can expect another increase from Reserve Bank of India.
Another 50. Because, so you are expecting
yes.
25 in 25 or 35 in September and another 25 in December.
No, I'm saying that in the, September again they may be raising it by 50 to front load, and then they will slow down. That's what I expect, because currently what is on their radar is also rupee. The rupee is suffering from depreciation pressure. So if overall inflation remains elevated, then they will finish off the quantum, and they will be aggressive now, and then they will slow down.
Fair enough. That possibility always exists. So there is one person expecting 50 as well. Whom am I left out? Jayesh, what are you expecting?
I'm kind of looking at 35, or not more than that. That's also on the outer side. I'm not sure about the next 25, right? So that
you mean they can stop at 575, you think?
Yeah, so that's the terminal kind of look. But of course, how the geopolitical sets up post-October and November, right? So you have Europe, the US, and China, all the three event in that month, right? So that would be the more deciding factor than anything on the global inflation as
In
well.
addition to inflation, we have to always be prepared for geopolitical surprises these days. I mean, I think I would go with what Rupa is saying. The Reserve Bank should worry about the currency if it is seen as being soft on inflation or in terms of rate hikes. Abhishek, I didn't ask you your thoughts after this CPI number. Any change in your expectations?
Well, 35 basis points this month, which is in line with what the swap markets are also pricing in. 25 in December, which should bring policy rates to 6%, which is broadly the level of neutral rate that we think RBI will be targeting. And we don't rule out some further hikes. If RBI is really serious about bringing inflation down towards 4% by the end of next fiscal year, then given the kind of inflation internals we have, I think growth is holding up reasonably well.
Yes.
In that case, and the kind of CAD picture we have, I mean, CAD is staying higher despite crude prices coming down. There could be a case for some more tightening next year, but we have to see how the global picture evolves to get a firmer handle on that.
So your peak rate assumption at the moment is 6 or 6.25?
I think it should be at least 6.5 if RBI is targeting inflation to come down towards 4%, but we are saying 6% by December.
Okay, I think that is more or less a consensus, 6% by December. And perhaps there's plenty of data and events in between for the reality to move either ways. Abhishek, Jayesh, Rupa, Upasana and Nikhil, thank you very much indeed for joining me and parsing the inflation and IIP numbers. The summary from the macroeconomic data that we have got is that inflation is a little worse than expected, coming in at 7%. After 4 months of falling, we have a higher inflation number, and it's a little higher than street expectations. The IIP number is a little lower than street expectations, coming in at 2.4, a bit of a disappointment on consumption, but we can ignore that for the moment and worry a little more about inflation. Thank you very much for joining this special broadcast on the state of the economy. Keep it with CNBC TV 18. There's lots more lined up.